Welcome back. We are at our last paper today. Today we are very happy to have Jeffery Zhang from CUHK to present to us his paper on finance leases, a hidden channel of China's shadow banking system. And the discussant will be Hongru from NTU. So Jeffery, the floor is yours. You have 25 minutes to present, and Hong has 20 minutes to discuss.
Okay, let's start. Thank you, Angie, for your introduction. I'm very glad to have the opportunity to present my paper, Finance Lease, a hidden channel of China's shadow banking system here. This is a joint paper with Professor Ting from North China University of Technology and Professor Yanping from University of International Business and Economics. So this paper is about finance lease, but it's also a paper related to shadow banking. And shadow banking is a very important topic in China's financial system, especially after the global financial crisis. If you look at the trend in the rest of the world, shadow banking activities are generally declining or sort of stabilized. But this is not the case in China. Since the 2008 global financial crisis, shadow banking system in China has grown very quickly. Actually, during the past 10 years, the size of China's shadow banking system has grown to about 70% of China's GDP. So this is a really an amazing phenomenon. So the interesting question then is how this shadow banking system has grown and what is the structure of this shadow banking system. So far, the academic research has shown that this shadow banking system mainly consists of the trust, the trust loans and the entrusting loans. And the trust loans in China by 2018 has reached to 22.7 trillion RMB. This is roughly 3 trillion US dollar. And the trust is basically a bank want to lend to a bank A want to lend to a firm B, but for some reason, for some regulation or other concerns, they cannot directly lend to bank B. The bank A cannot directly lend to firm B. Then they sort of find a trust company as a bridge. So the trust company will issue a trust to the firm B and then sell this trust to a off-balance sheet financing vehicle. Usually it involves the wealth management products. So that's the trust, and the entrusted loan usually refers to the firm-to-firm lending, but in some cases this is just a cover. So the firm A lend to firm B, but essentially the firm A's money is also from the bank. The bank cannot directly lend to firm B, but so they choose to use firm A as a bridge. These are two types of shadow banking, which has already been documented in the literature. Here in this paper, we want to demonstrate another type of China shadow banking system, which is the finance lease. And actually, the size of the finance lease is very large in China. It's 6.7 trillion RMB or 1 trillion US dollar by 2018. And so this paper is both a paper about finance lease, and it's also a paper about China's shadow banking system. And as you can see from the right-hand plot, the size of China's leasing industry has grown really, really fast. So before 2008, there's literally non-exist, right? But then it has grown really quickly. As you can see that in about 10 years, it has reached to 6.7 trillion RMB. And this is the second largest leasing market in the world, only after the United States. There are actually two very interesting characteristics of China's leasing industry, which makes China's leasing industry essentially the collateralized debt in China. So the leasing industry traditionally can be divided into two parts: the finance lease and operating lease. Operating lease refer to the short-term lease with no transfer of ownership eventually. But then the finance lease usually refer to the long-term lease, and in most of the finance leases, eventually after the leasing term is ended, the firm will eventually buy the ownership of the equipment. So that's finance lease. And in China, more than 80% of all the lease are finance lease. This is in sharp contrast to the United States, where operating lease actually account for over 90%. So this is one major difference between the China's leasing market and the United States and the rest of the world, actually. And the second is that in China, this so-called sale and leaseback type of lease dominant the market, account for 84% of total lease in the United States. So basically, the lease can be divided into direct lease and sales and leaseback. The direct lease is that if a firm they want to buy buy a machine, but they don't have the money, so they ask the leasing company to buy it, and then they borrow the machine and pay the rent monthly or quarterly or annually. This is a direct lease. The SMB lease refers to the situation that the equipment is already belonging to the firm, but the firm decided to sell the equipment to the leasing company and then borrow it back. So the machine never ever really leave the company, leave the firm. So essentially, SRB is like a collateralized debt. And this is the dominant form in China, but it's seldomly used in the U.S. So that's the very impressive characteristic. Okay, so based on these two, the finance lease dominant the operating lease, and SRB lease dominant the direct lease. As we want to see that the lease in China, finance lease in China, is essentially a collateral debt. Okay. So this is our main finding. Our main finding is that banks actually use their affiliated leasing firms to extend credit to firms. So finance lease essentially provide a channel for banks' shadow banking activities. This is our major finding. Second, banks actually use the finance lease to circumvent the targeted monetary tightening policy. So why banks do not directly lend to the leasing company, to the firms they want? It's because the Chinese government, they impose a lot of regulations, and this regulation prevent banks directly lend to their target firms. That's why they choose they choose to use their affiliated leasing firms to extend the credit. Okay. And then we further explored the risk-taking behavior of banks, because usually people think that shadow banking activities usually involves a lot of risk hiding, right? The banks, they use this shadow banking system to hide the risk, to take excessive risk. But here in this paper, we show evidence that, in fact, banks are not using their affiliated leasing companies to take excessive risk. Instead, they have taken their customer very carefully, and they use this leasing channel to support their customers. And the risk in bank affiliated leasing firms are actually lower than those non-bank affiliated leasing firms. So this is our major finding. So to connect our finding to the literature, first, our paper sort of contribute to the growing literature of China's shadow banking system. There have already been many papers studying the structure of China's shadow banking system. So our paper actually show another channel which has been understudied before, which is finance lease. And we show that finance lease provides a channel for banks to conduct shadow banking activities. And we also provide better identification for banks' regulatory arbitrage. And we show that we need to think more carefully about why banks want to engage in shadow banking, not simply just to take more risk and try to gamble for more profit, but instead there could be strategic thinking behind it, and the market somehow is working even in the shadow banking system. Okay, and our paper also connect to the leasing literature. The leasing literature usually focus on the difference between the lease and debt, and also the difference between finance lease and operation lease. This paper show another dimension: the bank affiliated leasing firms lease versus non-bank affiliated leasing firms lease. And thirdly, our paper also contributed to the relationship banking literature. So this is a large literature which shows that the bank-firm relationship can have a real impact on firms' loan accessibility and the interest rate. But this paper shows that the bank-firm relationship can also affect the bank can also affect the bank affiliated leases, and the bank can use their affiliated firms can use their affiliated leasing firms lease to support their firms, their long-term customer firms, which are in short of credit. Okay, so the data in this paper comes from the annual report of China's public listed firms. We hand collected each finance leases disclosed in the annual report, thanks to this compulsory disclosure requirement for the finance lease. And our data covers from January 2007 to December 2019. We have collected 1,300 leases made by 430 unique companies. Okay, and we collected the firms, the leasing firms, the leasing amount, and the rate, and the leased asset, and etc. Okay. And we also sort of collected these leasing firms' bond issuance information. Okay, and in this paper, we actually exploited the global financial crisis as a DID test. So as we all know that the global financial crisis has created a lot of shock, a huge shock actually to Chinese economy. And to respond to this global financial crisis, the Chinese government launched a large-scale stimulus plan. It involves like both physical 4 trillion RMB physical stimulus and also the loosened credit supply. Then we immediately see the consequence. The economy bumps back, but the problem is that it creates serious overcapacity problem. According to IMF estimation, that the average industrial capacity utilization has dropped from 80% in 2007 to only 60% in 2011. And also this caused a lot of trade conflict between China and the rest of the world. So under this domestic and the foreign pressures, Chinese government launched this this campaign to constrain the rapid expansion of overcapacity industries. Basically, the Chinese government listed all these industries: the steel industry, the electronic, the alarm industry, the aluminum industry, the coal, ships, cement, flat glass, all these industries as the overcapacity industry. And the Chinese government requires the banks to tighten their credit supply to these industries. And this actually created the credit constraint to firms in this industry. And this industry was implemented by the end of 2009. And therefore, we used this 7-year window from 2007 to 2013, centering around year 2010. And we use this window to conduct this typical DID test. Basically, we use those firms which are not affected by the policy as the control group. We use the firms in the targeted constrained industry as the treatment group, and we run this DID test. And as can be seen, and actually the dependent variable we use both the dummy variable, the bank. So if a firm actually get a finance lease in that year, then the dummy is equal to 1. And actually, we divided the finance lease into bank affiliated lease and the non-bank affiliated lease. If a firm actually get a bank affiliated finance lease, then the dummy equal to 1 in that year. Otherwise, it's equal to 0. So we use this dummy to as a dependent variable, and we run this DID test. And this policy is certainly the variable which we're interested. And as we can see that after the implementation of this policy, these affected firms, they are more likely actually to take bank affiliated leases. We also use continuous variables. We use each firm's annual amount of new bank affiliated leases as the dependent variable. We also use the amount of new lease over the total asset as dependent variable, and the results are all consistent. Basically, they show that after this shock, after the constraint, these affected firms, they turn to the bank affiliated leasing firms and to take finance lease. We also take another test. We also we use the non-bank affiliated leases as another example to do another test. But we find that there's no impact. Basically, after this policy was implemented, these firms, they do not increase their participation in the non-bank affiliated leases. They increase more in the bank affiliated leases, but not increase their participation in the non-bank affiliated leases. This is our major finding. And we also use this test the dynamic effect of the credit tightening. And the policy 0 is the year 2010. And we find that before the policy was implemented, there's no difference between the treatment group and the control group. But after the policy was implemented, you can see that there's a significant increase in the leasing amount. And the bank affiliated leases has increased. And here, this is the plot. Right? Before the policy was implemented, the treatment group and the control group are literally roughly the same. And then afterward, the policy was implemented, the bank affiliated leases has increased. And this is for bank affiliated leases, and this is a similar test for non-bank affiliated leases. As we can see that before and after the constraint policy, there's no difference between the control group and the treatment group. Okay. So hopefully I have convinced you that the policy has increased the firm's chance to engage in bank affiliated leases. And now I want to take a closer look at the interest or the leasing rate, the funding cost of involving in these two different types of leases. Here we find that this 5.7, this is the average bank affiliated leasing rate. This is 5.7%. And this is the non-bank affiliate leases leasing rate. And the difference is significant. Basically, if you involve in bank affiliate leases, your leasing rate is 80 basis points lower than involving in non-bank affiliate leases. And we also made some adjustment, and the difference is even larger. We use the bank loan rate, the benchmark bank loan rate as our benchmark here, and then we get the adjusted leasing rate. So basically, you can see that the bank affiliate leasing rate, affiliate leasing rate is roughly the same as the bank loan of the similar maturity, while the non-bank affiliate leasing rate is 1% larger than the benchmark bank loan rate. The difference is 1.1%. So from this plot, from this table, it's very clear that the bank affiliate leases is not for making profit, excessive profit, right? And also from other dimensions, bank-affiliated leases are larger than non-bank-affiliated leases, and the maturity is also longer. Average maturity is 4.5 years compared to non-bank affiliated leases, which is only 3.4 years. Okay. And we also checked the credit risk. So for the non-bank affiliated leases, we actually use a firm's default on their lease or turn into ST firm. ST firm means that the firm has faced serious trouble in their operation. Although the lease is not defaulted, but the firm faced into trouble, operation trouble. So we find that 7.5% of the bank affiliated leases eventually face this credit trouble, which is compared to 9.0% for non-bank affiliated leases, which is smaller. And by combining these two results, we can see that the bank affiliated leases actually they charge lower interest rate and they have lower credit risk. And we also then checked on the funding cost of these different the funding cost of leasing firms. As we can see here, that bank affiliated leases, when they try to issue bond, they on average were charged 78 basis point less than non-bank affiliated leases. Basically, the bond market think that the bank affiliated leasing firms are much safer than non-bank affiliated leases. And we also look at the stock market reaction. We find that, when a firm, they announce that they get a bank affiliated leases, there is abnormal stock return. But for non-bank affiliated leases, if a firm announces that they get a non-bank affiliated leases, there's no abnormal stock return. There's no abnormal stock return, as you can see here. This means that stock market also trade bank affiliated leases as a good news for firms. This means that market think that the firm still maintain this relationship with the bank. And this is good for the long-term development of the firm. But if the firm announces that they get a non-bank affiliated leases, it means that they cannot maintain the relationship with the bank. But on the other hand, they still get the funding. So this is a sort of a neutral. Okay. So this is our major finding in this paper. Basically, we find that banks, they actually use their affiliated leasing firm as a channel to provide credit to their clients. And in this process, in contrast to general thinking that the bank would use it as an opportunity to take more risk to sort of escape from the regulation, bank are actually doing it very strategically. They lend cheaper and they take low risk. They sort of do the cherry picking, right? They only choose the high quality client to support. And when they use the finance lease, they're very efficient in their pricing. And also their funding cost is low. And the market really know what's going on. And overall, I think that the finance lease is a very interesting channel, and the regulators should really, when they think about how to regulate the shadow banking system, they need to look at the details. They need to look at different channels and think twice before regulating very heavy-handed. So this is the paper. Thank you.
Thank you, Jeffrey. The discussant is Ru Hong from NTU, MBS.
Again, thank you very much for this opportunity to discuss this very interesting paper. And personally, I learned a lot from this paper. Yeah.
I think you need to set the. We are seeing two screens. One with your notes and one.
I think we are looking at the presenter view. So you
so you need to switch. Yeah.
Is this better?
Yes, this is good. Thank you.
Okay, yeah, the Zoom, I'm still figuring out how to use that. Yeah. So yeah, thank you very much. And since Jinfan, Jeffery did a good job in presenting the paper, so let me just quickly summarize the main findings of this paper and jump to my comments. So this paper studies the role of financial leases in China shadow banking system. And the authors sort of documented substitutions between the formal bank lending, which is the bank loan, and this shadow banking channel, which is the financial leases. And they find that after a policy shock, after the regulator restricted the formal bank lending, the bank loans, the banks somehow circumvent this regulation by using the financial leases as the channel to keep lending to the firms in this regulated industries. And they also find that such financial leases mainly target the low risk lessees with better loan contract terms. So for example, they have lower leasing rates. So potentially this will be better, will benefit these firms in this overcapacity industries. So overall, I think this is a very nice paper with the very interesting data, and I do appreciate the author's effort to manually collect this very amazing data set. So it actually about one of the most important research questions across the globe, the role of shadow banking systems, including China, which is the second largest economy worldwide. And in the literature, we have already seen a couple of many studies on the China's shadow banking system, for example, the entrusted loan market, the wealth management product market. But this, I think this is to the best of my knowledge, this is the first paper to talk about the financial leases in this shadow banking market in China. So I think this is very interesting. So overall, I think the empirical analysis are very solid. I do not often say that, but they check all the boxes, like in different setup. They have a clean control group, treatment group, and they present very solid parallel trend assumptions. So overall, I think this paper is the empirical analysis are very solid and also very well written. So I encourage everybody to read that paper. So I have some comments on the interpretation of the results and the narrative of the paper, and I still have some minor comments on the empirical exercises of this paper. So my first comment is that in this paper, the main idea is to show the substitutes between the bank-affiliated finance leases and the formal lending. So again, the author basically show us when the Chinese government cracked down the bank lending to these overcapacity industries after 2010, and the banks sort of circumvent this regulation to use the financial leases to fill into this gap, to continue to lend to these firms that are regulated after 2010. But if you look at the coefficients is estimated, so for example, in table 2, column 2, the traded firms increase the probability of having financial leases from 0.49% to 1.09%. So if you look at the growth, it actually doubled, right? From the 0.5% to 1%. But if you look at the level, it's only 1% firms that are having the financial leases. So the magnitude is not too big. So I'm thinking about how strong is this substitution effects. And but the author later shows that the amount of financial leases increased by like 174%. But I guess because you use the log, lease amount plus 1, you have a lot of zeros in your regressions. So I'm not surprised to see this big numbers if you use the log, the lease amount. But so my question is that how important is this substitution effect by using the financial lease to sort of to fill in this gap on the reduced bank lending? And the related point is that it might be also useful for the author to show that what is the decreases, the magnitude of the decreases in formal bank lending, so these bank loans. I believe that you should be able to find the aggregate data at the bank industry level. So you should be able to see that after this regulation, in these overcapacity industries, these firms, they lose these bank loans by like 1 trillion or 2 trillion. But on the other side, you have this financial leases that can fill into part of this gap. So I think this is very important to for you guys to sort of quantify this effect for the readers to understand the magnitude of this substitution effect. And one additional point is that I try to understand this 1%, like 0.5% to 1% increase, but I try to find the summary statistics of these main regression variables in the paper, but I can't. So it is hard for me to really to understand this magnitude that you have in this from this regression estimated coefficients. So the current version of the paper only show 4 variables about this leasing contract in table 8. So I strongly encourage the author to give us this detailed summary statistics about these main variables. So as a reader, we can better understand the magnitude of these effects. But overall, I think that has been said, I still think this is a very important channel because in figure 1, you do show that the leasing market in China somehow reached to 7 trillion RMB in 2019. So this is almost the similar size of major commercial banks in China. So I think overall this market is huge, but I just have hard time to reconcile between this huge market size of the leasing market versus the magnitude you have in this paper. So one potential explanation could be that you only look at the listed firms and you manually collected this data. So maybe most of the leasing activities happen in this private firms, unlisted firms in China. So that could be one explanation, but I think at least you might want to discuss this in your paper. So the second comment I have is also related to the magnitude. So in your table 5, you show that the bank customer relationship matters. So basically in table 5, you show that the treated firms that have relationship with the banks. So for example, they are the borrowers of the bank loans in this particular bank. They increase the probability of having financial leases from 0.19% to like almost 0.6%. So the idea here, your idea here is that it's to show us this substitution effect. So this existing borrowers of the bank, after the shock, they might reduce their formal bank loan borrowings from the bank, but instead they are able to increase their financial leases in a significant way. So to fill in this, to substitute to the formal bank lending. But at the level, I'm a little bit confused here. So basically in the overall example, you show that after the shock, 1% of the firms, they can borrow these financial leases. But for these bank customers, they can only like 0.6% of them can borrow that. It actually lower than the average. So this means that many new financial leases actually target for non-relationship borrowers. So if that's the case, then it's more than just the substitution. So I think when you write your contributions into the literature, you might want to help us to understand this intensive versus the extension of the leases, whether they do really target these existing borrowers as the substitution of the former bank lending channel, or they actually use these financial leases to target the new customers at the extensive margin. So I think that's also very important for us to understand that. So the next comment, I think, so again, I'm largely convinced by the empirical analysis. Like I said, you did a good job to verify your different analysis by showing us this parallel trend analysis. But I wanted to push you guys a little bit further to show more evidence on the fundamental channels underlying these substitutions. So for example, how do these funds flow from the parent banks to these leasing firms? So basically, you're telling us the story that when the formal bank lending channel was cut off or restricted, the bank can circumvent these regulations by channel the fund from the banks to the leasing firms, then to these firms, these borrowers. So I think it will be very useful for you to show us how the money actually flow from these parent banks to this leasing firm. So in this paper, you give us some discussions about the implicit guarantee, the bond issuance underwriters, but I wanted to push you a little bit further to show us this additional direct evidence to show us exactly how these funds flow from these parent banks to this bank affiliated leasing firms. So my the last comment, the major comment, again, I have a couple of sort of comments on your identification, although I just said you did a good job in your DID approaches. So first of all, as you mentioned before, the regulation shock was in 2010. So this is right after the famous 4 trillion programs. So how does that affect the interpretation of the results? So specifically, these regulated industries, they borrow a lot of money from the banks or from the government banks during the 4 trillion program before 2010. Then the government started to worry about this credit flow to this overcapacity industries. So in 2010, they sort of cut down these, sort of wanted to restrict this funding to keep flowing into these industries. But these firms, actually, they borrow a lot of money. So they have the pressure to roll over these fundings in the future. So how does that affect the interpretation of the result? So in other words, whether these financial leases, they play a role in this evergreening process, or they actually can enhance the firm valuation like you find in the stock market reaction. And the second is that it is good to show the parallel trend, and I wanted to push the authors to include all these parallel trend dummies in all their tables. I think this is a very standard in the literature, and maybe also show us some unconditional patterns for this parallel trend. So the last one, I think it's quite minor. So it seems that the non-bank affiliated leases are not affected by the shock. So maybe when you study the economic consequences of the increased financial leases, you might want to use that as the control group, because from your analysis, these non-bank affiliated leases are not affected. Their size, their contract terms, it seems that they are sort of immune to the shock. So they can act as the control group to estimate the economic consequences. So that could be the next paper. So just a very minor comment. So I searched this financial leases in news articles yesterday, and I find that actually the regulators in their official report, they say that the China's shadow banking sector shrank to 84 trillion yuan in 2019 from the peak of 100 trillion yuan in 2017. So why the the reason for this reduce the size of this shadow banking system is that they redefine the shadow banking sector. So the article name is that the China's $13 trillion shadow banking sector gets clear definition. So this is the broad definition before this article. So you see that we have a lot of different products in the shadow banking system. So for example, the entrusted loans, the wealth management product, and also the financial leasing companies. But after 2019, when they redefined this market, actually the financial leasing companies are not in the regulators list to the formal definition, the narrow definition of this shadow banking market. So I think when the authors wanted to say some policy implications, you might want to be a little bit careful because you don't want to argue with the regulators. Okay, so overall, this is a very nice paper, and best of the luck in publication. Thank you very much.
Thank you.
Thank you, Jeffrey, and thank you, Hong, for the very good discussions. Now, we are going to open the floor to the panelists as well as the attendees for the Q&A session. Now, just for the benefit of those who just joined us again, you can ask questions either through the chat, or if you would like to speak, you can just raise your hands. Okay, the raise hand button is at the bottom of the Zoom window. So feel free to ask any question to Jeffrey. And before that, I forgot, Jeffrey has to comment back on Hong's comments. Jeffrey, you can take the floor for now before we get take the question from the audience.
Okay, thank you, Hong. Thank you so much for your very constructive comments. And you have really read the paper very carefully. And for your second comments, the bank customer regression, we do agree that there's this data limitation on the bank customer relationship because we really don't have a very comprehensive bank loan level data. We cannot build up this precise relationship between a firm and its bank. The only bank firm relationship depends on firms' voluntary disclosure of their loan relationship with the bank. So sometimes if they don't disclose, we don't really know the existence of this relationship. That's why this result can be biased a bit. And also for the fund flow, as for your comment 3, we will try harder to dig out this fund flow. But in general, for a bank and its affiliate leasing firm, usually there's actually the regulation that bank cannot directly lend to its affiliated leasing firm. But the common practice in industry is that Bank A has its affiliated leasing firm, and Bank B also has its affiliated leasing firm. A cannot directly lend, B can also cannot directly lend either. But then there's this hidden agreement between Bank A and Bank B. So Bank A will lend to Bank B's affiliated leasing firm, and Bank B will lend to Bank A's affiliated leasing firm. And there's this sort of a cross guarantee behind. But certainly this kind of a contract will not be disclosed to academics. But we'll try harder to sort of show some evidence on the fund flow. Thank you very much.
Okay, now we'll open the floor for Q&A. There is a question from James. From James, do you want to raise your hand to ask the question yourself? Okay, so I'm going to ask the question on James' behalf. So does the changes in the leasing accounting, I mean, we are not sure how maybe China, what is the lease accounting arrangement like in China, but is there an impact of changes in the if the IFRS 16 affect leasing accounting in the accounting for leases in China?
I think that the finance lease firm, the finance lease in generally enjoy a better sort of a, let me see. I'm not an accounting guy, so I'm not really familiar with the details of the leasing accounting. But my understanding is that there's a different accounting treatment regarding to different leases. But that's not the dominant reason why the Chinese firms they choose finance lease compared to operation lease. Actually, in general, in Chinese leasing market, the regulators always encourage the development of the operating lease. They think that this is really the dominant form in the rest of the world. And for operating lease, this is not just lending the equipment. It also in regards to providing services, right? If a firm borrow some equipment, they also get the services of how to maintaining, how to operating this equipment. That's how the leasing firm will create value for the customer. All these added value, this services. But for finance lease, this is basically no service attached. This is just a funding channel. So this is relatively low in this leasing industry. But in China, we see slow growth of operating lease, but still the finance lease dominant, and that's not due to accounting reason.
I see. Now, Randall has a question. Randall, do you want to speak directly? Hello, hi.
Hi, Randall.
And Randall, you're muted, I think. No,
Sorry.
we can't. Let's see whether I can unmute. Okay, here it's all in the chat. Okay, could you please talk more about who the shadow banks residual claimants are? And yeah, so could you please talk more about who the shadow banks residual claimants are? That's Randall's question.
Pardon me, what is Randall's question?
Could you please talk more about who the shadow banks residual claimants are?
Is my audio working now?
Yes, your audio is working perfectly now.
So who owns these who owns the shadow banks? Who is the person who stands to lose money if the shadow banks fail? And who controls them? Is it the bankers or is it somebody else? And how close are they to the government?
Okay. So there are basically two types of leasing companies. One is bank affiliated. These companies are controlled by the bank. Usually, banks owns 100% share of these leasing firms.
How much percent?
100%, or at least over 50%.
Okay.
We define bank affiliated to be those leasing firms which bank owns over 50%. Most of the cases own like 100%. And in China's banking industry, actually banks are very proud to have affiliated leasing firms. This means that they have diversified business. They are a banking group, not just a bank, but a banking group. They have diversified business. And eventually, from the law's perspective, if the bank affiliated leasing firms go into bankruptcy, then bank will not suffer actually. But everyone in the industry think that if there's any problem, the parent bank will eventually step in and help these bank affiliated leasing firms. That's the general belief. And so far, there hasn't been any bank affiliated leasing company go into bankruptcy.
Okay. And the other kind that are not bank affiliated, who controls them?
That's kind of complicated. Some of the largest are actually controlled by business groups, like the the equipment manufacturer. They want to sell their equipment, and therefore they establish this financial leasing firms to help their customer to buy their products. And there are also thousands of small and medium-sized leasing companies, thousands of actually. And they sort of provide funding to small and medium-sized firms. And that also goes to Hong's first question that our data actually only covers the finance leases extended to the publicly listed firms. These are the largest customers, but the majority of the leasing market actually target the small and medium-sized firms, which are not publicly listed firms.
Do we have any idea who would lose money if they go bankrupt, or or would anybody bail them out?
They are not supposed to be bailed out. They have no connection to the bank, and we so far we still don't know a lot about who these small listing companies are and how do they actually secure their funding, and if they have what's going to happen.
Thank you.
Thank you.
Thank you, Randall, and thank you, Jeffrey. Okay, Johan has a question. Johan.
I think this is related to Randall's question about how do the banks actually finance this additional lending, additional leasing? Because you said that they are the owners of this leasing companies, so presumably they put in they paid capital. So I'm curious as to how do they come up with the funds to do that. And the second is related, if you have a lot of banks who are doing this, then presumably this channel will be saturated versus in locations where there are not many banks who are doing this. So I'm curious as to, is there any differential effect for different locations depending on, first, the number of banks in the area, the amount of deposits or the amount of assets they have, and second, the willingness of banks to participate in these schemes. So I don't know if you can speak to those.
Okay, we can certainly check on these things you have raised. But in general, banks, they have the money, they want to lend to their customers. But the problem is that the government do not want them to lend because these firms, they belong to the overcapacity industry. So from the central government's perspective, these industries are overcapacitated. Therefore, the central government's incentive is to sort of shrink this industry. But from the bank's perspective, they can identify which customer is good or bad. There's an old saying in the banking industry: there's no bad industry. There's only bad firm, which means that even in the worst industry, there are good firms. So the banks, they sort of know which firm is good, and they still want to lend to their customer. But from the central bank's from the government's perspective, they want to constrain. But the central government do not know which one is good, which one is bad. Therefore, the central government used this one-shot policy. They cut all the additional funding to this industry. But banks then want to sort of help their high-quality customers. So that's why they sort of try to find different channels to still, provide credit to their high-quality customers. So this is our story based on our evidence. So that's why we see that the quality of these finance lease, they're not bad actually. They are relatively high quality compared to those non-bank affiliated leases. And they have the money, they want to lend. It's just that they want to avoid the government's regulation, and that's the finance lease.
Thank you. Ron has a question. Ron, hi. Ron?
Okay, I think I'm here. I'm curious whether there's still some types of potential conflicts of interest by the bank decision makers and their influence on the leasing related company. In particular, I'm wondering if you've got much larger size loans and maybe longer maturity loans to the bank, does that increase your chances of getting a financial lease approved? And then after you get a lease approved, is it more likely that the banks will renew additional loans to the same borrower?
Okay, I see. These are all very good points, and we can definitely go back to check on that. We do find some evidence that if the firm already secured loans from the bank, then it's more likely for them to get the lease when they're in trouble. That's what we find. But on the other hand, if they get the lease, whether it's more likely for them to get a loan, we need to go back to check more. Our understanding from an interview with industry practitioners shows that usually the banks, they have very close relationship with their affiliated leasing firms. Sometimes they even do the field trip together to visit the customers. And they share the same risk management system. And they usually even share the same staff. Or sometimes the staff, they work like 10 years in the bank and then they were transferred to the affiliated leasing firms. And the leasing firm and the bank are probably located in the same building. So they
Sounds pretty close.
Yeah, really
Sounds very close. I guess that seems to reinforce my thoughts that if these are particularly large loans or longer standing loans before they mature, that they're more apt to want to make these leases happen. But I think that could be interesting to explore. Do you know if most of the bank loans, many of those are collateralized, or
yes,
whether those?
Most of the loans in China are collateralized loans.
Okay, so when they do this financial lease, this is on assets that are not currently collateralized. Is that correct?
Yeah, they're supposed to not be collateralized.
So how is it that some assets are not falling under the collateralization umbrella of the existing loans? Seems a little bit curious.
Yeah, I don't know exactly how this happened. Yeah, but in general, what we find is that when there's this lending limitation or lending constraint being imposed, that these firms they were forced to sort of go to the finance lease company to get the money. But it also goes to Hong's comment. We don't know whether this money are used to do the refinancing or to invest in more projects. I guess it's more likely to do the refinancing. The bank asks them to pay back the money. When the loan is mature, the bank asks them to pay back the money. They don't have the money, so they use this collateral asset to put it to sell it to the leasing firm to get the money and then pay the bank. That's possible.
Okay, it's still a little puzzling to me exactly which assets are being collateralized in the leases, right? And it seems like it would make sense. It would be new assets that wouldn't fall under the existing loan restrictions. But anyway, thanks very much.
We still need to check whether it's allowed to sell the collateralized debt or not, collateralized assets or not. Okay. Most of the time we check based on our reading on the annual report. These leases are equipment, specialized equipment, staying in the plants. They're not land. Sometimes some assets are land, but most of the time they are equipment.
Okay, thanks.
Thank you very much. Any more questions from the audience? If not, thank you, Jeffrey. Thank you, Ruhong, and thank you for all the audience participation. We have come to the end of the first corporate finance segment of the ABFER 8th annual conference. So there will be another corporate finance segment at 3 p.m. today, Singapore time. So I'll see you guys then. Otherwise, have a good
Thank you.
rest of the day and stay safe. Take care.
Bye-bye. Thank you.
Bye. Thank you.